This is Tom Nonamaker with the Capital Discussions Roundtable with our guest Evie, who will be talking about SPX Puts and hedging your portfolio. Now, before we get started, a quick disclaimer that Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer-simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. And again, this is for educational purposes only. So with that out of the way, welcome, Evie. It's the first time you've been a presenter with us, and well, it's nice to have you here.
Well, thank you very much. It's nice to be here. I want to thank everybody ahead of time for being patient with me as I am recovering from this cold. So I'm going to try not to cough in everybody's ear holes. I want to be sure that you're seeing my full screen, first of all. Yep. Okay, so it's not the, I'm sharing the right one. Yeah, I can see where the green box is. So, well, thank you for having me here today. I appreciate the opportunity to share, because I've gotten a lot from listening to a lot of the various presentations and discussions that have taken place at Capital Discussions over the last few weeks. So I really appreciate the opportunity to share, and hopefully somebody can get a little bit from what I am sharing here today. So I know you've shared the disclaimers already, Tom, but as one of my mentors, Matt Haley, says, you're an adult. Everyone listening is an adult. You take responsibility for yourself. No one else is going to do that for you. All right. Well, here's a very quick background. This is me, not that. That's my husband. And we're originally from Europe. We're both born and partially raised in England, and we've been living in the United States since the year 2000. My background is I'm a CPA, at least that's what I did when I was in the UK and for part of the time here in the United States. But just because I had a finance background didn't mean I knew anything about investing or trading. I started learning trading almost 10 years ago now, 9 years ago at Invest Tools, which is part of TD Ameritrade. And probably since about 2009, I've been running a local user group as well as some online stuff through Invest Tools. I've also had the opportunity to present at some of the TD Ameritrade /Investors conferences since 2012. So the presentation I'm giving today is an adaptation of the one I did for the Anaheim conference last summer. I don't trade other people's monies. I invest our own, and I primarily, invest in stocks and ETFs. I do a lot of trend trading when there is a trend, which it is not right now. And when I say trend, I mean more intermediate trend, like in weeks to months. I also trade some bearish butterflies and calendars. So before I go into the detail, I just want to give a little background about what it is this is about. This is not a primarily designed to be a trade to be made by itself as a moneymaker. Although it has over time done really well in and of itself, the primary purpose of it and the way I started designing this was so that it can act as a hedge on a long portfolio, like IRAs and longer term investments. So I just want to reiterate that my primary objective is not to make money on this. If the market is screaming to the upside, I don't expect that I would make a lot of money, if at all, here. But at the same time, I don't like to lose. So I'm working pretty hard to make sure that I can make this at least be at a break even. So what's a hedge? Hedge is an investment that one makes to reduce the risk of adverse price movements. That sounds like very grandiose, but let's just say the market is in an uptrend, and then if we get a pullback, we want to have, I like to have a hedge on so that I don't end up losing a lot of money or as a one-for-one when we get a pullbacks in the market. So that's talking about a hedge in terms of a bull market. So what do you use for hedging? There are many instruments, but the primary ones that most traders I know are using are options, either just buying long puts or hedging with futures. But of course, there's a whole array of combinations that one can do to hedge an account. Now, a perfect hedge, assuming somebody doesn't want to take any risk in the market, is to reduce the risk to nothing, but that can also eliminate the ability to make money. So again, the circumstances would vary from person to person and also from individual risk tolerances. So what I am going to share with you is how I try to hedge a small portfolio whose results I'm going to share with you today by the use of options. So in my case, I'm going back to January 2015, so we're almost 15 months into it. And at that time, there was about 60% in equity in that portfolio, about 30% in diagonals along options, calls mostly. And I started off with about 10% in hedges, and those came in the form of index puts or calendars, and also some bearish butterflies. I know a lot of people in this call are probably familiar with some of the bearish butterfly rules, so I use my own variation of that. So we can argue and say what type of a market are we in at the moment, and we're definitely, in my opinion, and that your mileage may vary, but I don't think we're in a bull market at the moment. So we can have a hedge. I can have a hedge up to about 20% of the account delta by deploying a lot of the hedges. If the market is sideways as opposed to a bull market, then that can increase, even to the point of eliminating any positive delta. Are there any questions at the moment? Because the way I have my screen set up, I'm not seeing the chat. Let me try and bring it up.
No question.
Okay. All right. So I'll move on. There we go. So the question is, I mentioned that there are futures and there are options. So why use puts instead of using futures? Good question. Neither of those is right or wrong, but by hedging with long puts, clearly a long put protects for down moves, but you can also take advantage of increases in volatility in down moves. So typically if, the market is going down strongly, the implied volatility increases. So as long as you're not very deep in the money or extremely out of the money with those puts, you can end up taking advantage, and the time premium value of those options can expand to because of the volatility. We can, if we have a lot of volatility, the market prices in that we don't know where we're going to end up, so there's more volatility, more time premium built to them. So why would I hedge? Following on from what I was talking about earlier, excuse me a second. Sorry about that. I see a question. Are you positive theta in your portfolio that you are trying to hedge, or are you only positive delta? It can vary, and at times when the market is not strongly trending, I would probably have long stocks or ETFs and might be selling some cover calls on them. But I'm talking primarily about hedging a positive delta. So this type of position can be either theta negative or positive, but it's mostly positive, and I'll share that information. So I haven't considered hedging. There's a question from Kevin here about hedging with some of the XXX short ETFs like the SDAO or SQQQ to avoid negative decay with puts. No, I think you'll see what I'm doing here, that I have gotten over the negative theta situation. So we'll just plow on, and then we can get back to that and discuss it, because I for sure will tell you I don't have all the answers. I've only been trading actively the strategy for the last 3 years, which to some may sound like it's a long time, but we haven't really experienced many different market conditions, so things can change. I also they used to call me the backtesting queen, but that was probably about 5 years ago, and I am kind of over that at the moment. Although I would welcome somebody who's very willing to work with me to possibly backtest during different market situations to see how we could adapt this strategy. Okay, so let's see what I'm saying here. So the hedges provide account stability. I'll start off by saying alpha. A lot of us want to be able to beat the market, and have better results. So by having some long puts, we can essentially smooth things out, because especially in my situation last year where I had a lot of long calls that I was trend trading, either by simply having the long calls on stocks that were moving strongly, but also at times I would sell covered calls on them and turn them into diagonals. But having the leverage of long options, such as call, then the volatility of the account can be quite dramatic. So if the market were to strongly go up, 2 or 3%, over a day or two, then I could find my account be up 10%. But at the same time, if the market were to pull back that 2 or 3% quickly, I would find that I would be down more than 10%. So adding a hedge element, in my case, SPX Puts, smooths out that equity curve and the volatility of the account. So I talked about, hedging 10 to 20% of the portfolio in a sideways market. So sorry, I'm repeating myself. So some of this stuff you would all know about index options, but they talk to your own tax person about this, but they are more tax efficient than using, say, individual stocks or options on SPY and the Qs. Using SPX or RUT, the tax treatment is generally that 60% of their results are considered long-term capital gains or losses. Let's not forget the other side. If you already got options authorization, then you don't need anything additional. So if you wanted to hedge with futures, you would need to have a special authorization. It's not automatic with all brokers. Additionally, I find that the index products are very liquid. I think I'm probably preaching to the choir here. What I love about them is they're also cash settled, so I'm not worried about assignment throughout the risk, the duration of the trade. And they're also defined risk. I know that we can say a futures contract takes up only X amount in margin. However, that margin can change. Whereas if I'm buying an option, that the risk is defined for the amount that I've spent, and I know that I can't lose any more than that. Yeah, at the time when I first did the presentation, people didn't know about the open outcry, but I know that that's kind of going by the wayside, so I'll skip over that. All right, so guidelines for my trade. So I look for the market to be at resistance or to have moved up at least 2 to 3% from the lows. The market's been a lot more volatile now, so maybe I need to revisit that exact amount, but I'm certainly looking at resistance areas before adding some of these on. The market needs to be in an intermediate uptrend or sideways. Again, I don't know exactly where we're at right now. I would say we're still sideways. We haven't turned full bear. So this is still working okay. So once I've determined that the situation is a deal for me to put the trade on, then I would buy SPX puts approximately 50 days out and 20 to 50 points below the market. So the long can be a weekly option, but obviously make sure that I make sure that there is enough liquidity, because sometimes when those weekly options open and they around the 50 days is when they open, there may not be enough open interest. The bid-ask spread might be wide. So I just want to make sure that there is some open interest and that the pricing is ideal. I haven't spent time looking at the different, just analyzing what is a correct or ideal ratio of the Greeks. But what I've learned from my experience was that if I buy around 50 days, and then the next point is to potentially sell a put 49 days to expiration, then all of last year and the year before that, I was spending about $30 or $3,000 per contract. With the increasing volatility, now that's gone up to 35. So that was part of the reason why when I first brought this strategy up, I was a little hesitant to share it, because I'm not quite sure that it can work with the pricing of the calendars if I enter it as a calendar being $35-ish. I know some of you who trade butterflies would know that, it depending on the pricing, you have the range extensions and the profitability ranges can vary quite a bit. So, a $5 difference in the price is actually quite significant, and that could be the differences between making money and not. So just to clarify, what I would be doing is buying that long call, and then if the SPX has not rolled over yet, so if it's on an uptrend still, so remember the market's at resistance or has moved up 2 to 3%. So if it's moving up, I may sell a short against it at the time I'm entering at the same strike. So it's a calendar. So let's just say the SPX is at 2,000. I'll just round things. So I might consider putting on buying a long call at, I'm going to say 1970. And then if the market hasn't rolled over, I would sell the 1970 in 4 to 9 days to expiration. Was there somebody speaking, Tom?
Yeah, Evie, you said long call. Do you mean long put?
I did mean long put. Thank you so much. I'm only talking about puts. The only time I mentioned calls, or I should have mentioned calls, was when I was talking about selling cover calls on my stocks ETFs, and also where I trade long diagonals, which is a whole other story. So thank you for picking that up. So
sure.
Yeah. Okay. So I thought at this point I'll share an example of a real trade, and I have a couple to share with you, and then I will kind of go back and share the rules on the management of this trade. So this is one that I think was an ideal trade as far as I'm concerned. I kind of overtraded a little bit, but it still ended up relatively well. So the yellow box down here, it shows the duration that I was in the trade. So this is the very end of 2014. Until the end of January. So I was in this about 5 weeks. So the SPX was at about 2070 or so, between 2070 and 2080 the day I put it on. So we had bounced strongly off support. We were at resistance area. So what I did is I entered I entered it as a calendar. You see, it hadn't rolled over yet at 2025. So the pink dotted line is the long, and it shows where that long would have expired. I didn't stay in until it expired, but that's how, that was the life of that option. And then there's these blue dotted lines that show the shorts. So I started it as a calendar, and it cost $2,555. Market, you know, went up a little bit more, and then it rolled. So it rolled over. So I could be arguing here and saying I just let that short expire and let the long work, which would have worked out great in that case. But what I did is I bought back the first short that I had sold and sold another one that had this duration. And I collected $4.40 against my initial cost of $25.55. Then it blasts through, and I'm sitting there tapping, wondering what I need to do, but I'm kind of being patient because remember, the volatility is expanding. So at that point, I'm still profitable, even though I had, you know, the SPX was down about 20 points below the short, which in fact it's a long and a short at that point. But then we get a bounce, and then I roll again. But since we had moved down, I was thinking maybe we will keep going down. And again, remember, my primary focus isn't to make a lot of money on this trade, but it is to hedge my portfolio. Remember, I had almost $150,000 in this account that I was trying to put a hedge on. So I rolled that short from 2025 down to 2000. And that ended up working pretty well because the market had moved down. So I was in that for a few days, and then I was able to buy that short back on that day. So even though it was below, the market had gone below where my short put was, I was able to roll down to, oops, I'm going the wrong way, sorry about that. I was able to roll down from 2000 to 1980 and collect another $9.70. So by then you can see, I'm just going to round, I collected $10 plus another $9. So I collected $19, and intrinsically this position was, you know, had a long that was at 2025 and a short that was at 1980. So had we continued to go down, intrinsically I would have at least $4,500. We didn't continue to go down, but you're seeing that I ended up collecting money and essentially paying down the cost of my long along the way. Well, that pullback didn't last, so we had a big bounce up, and then I thought, well, I'll turn it quickly back into a calendar because this is going to blast through. Of course, that didn't happen. Had I stayed down here, I would have made a lot more money than I actually did. Somebody needs to help me stop over trading, and that's got to be my head, right? But then I rolled again, and I collected another $9. So I've more than paid for my trade now, and I still have a position that can make me money if we get another rollover, which we did. And the reason I said I overtraded, this is hindsight again, you know, you make decisions on a slight discretionary system like I have here, but I ended up with closing it on that day, which was about 2 weeks before the long expired, and that's part of my rules, and I collected another 2,200 odd. So during that time from when I entered to the time I closed, the SPX was down 4%. And I was able to make about $2,500, so 100%-ish of the the initial cost. But you see how the profit that I made was partially from the long and also from the short. So even though you're, in this case, the market was moving down, I made money on selling short puts. So this is why I love the multi-month strategies as well as the, just doing some that are in a single expiration, because I could take advantage of volatility. I mean, this is the volatility that is ending up enabling me to collect such a big credit when, even when we end up in the money. So I'll stop there and see if there are any questions.
There were a few. Let's see. So Kevin asked, what about hedging with three times ETFs like SDOW or SQQQ to avoid negative decay with puts?
Mm-hmm. And that was something that I kind of read that earlier, and it was that, yeah, I mean, I'm sure that that's the way to do it. I think depending if you're doing that in an IRA account, and again, I'm not your tax person. I don't even do my own taxes, even though I'm a CPA. But you need different amounts of margin. In this particular case, I know exactly what this is costing me. This cost me $2,500, $2,600, say. So I know that that's it. I'm done. I'm happy potentially to lose that entire amount. Well, I'm not happy to lose anything ever, but I just know what my risk is. So I don't like those leveraged ETFs, but everyone is different. But as I showed here, I did in this particular case, even though the SPX was down 4%, it was 4%. It was down 4% in the duration, but essentially it had gone down 4%, almost 4%, I would say, within 2 weeks of me putting it on. So it was a very quick, but I was able to still maintain this trade. Go ahead if there are other.
And then Chuck asked, is the sold put at the money or the same strike as long?
Okay, so when the example I showed, it started off as the same as the long, and then I rolled it down towards further out of the money. At no point do I end up chasing it and selling the put, the short put above the long put. I don't want to turn a trade that I want to be bearish into a bullish trade, because that's essentially what I would be doing. Like think of doing a bull put spread or a short put spread. You buy a long option lower than the one you sell, so that's essentially a bullish position. Now, I'm not going to go into it in finite detail, but if you're doing it, if I were to sell the short above, it could still potentially be negative delta, but my bias at that point is a little bullish.
Okay, and Andy asked, he said the one issue with hedging with a long put calendar is that if the market tanks, let's say minus 5 to 10% in a given week, and your long portfolio sinks, and the hedge also goes against you because short-term short put will gain considerably more than the long-term long put. Any thoughts?
Yeah, for sure. Yeah, like if you put a trade on and the market really tanks quickly, then you can end up, like if that move had happened and like I put it on and then we ended up 5-6% down, then I could end up losing. But you've got to remember that I'm already putting it on 20, 30 points below the market. So in that case, that day it closed at about 20.75, say, and I put it on 50 points lower. So can we get flash crashes? Of course, I think most of us, I'm just seeing the comment about the Fed saying the market's taking off. No, but there's 50 points there. So I could, if we were to get that and it was so dramatic that I didn't have a chance to do any rolls and pay down the cost of it, then, you know, a 50-point move here, even a 60-point move, that would still not have hurt this, and I could make the decision to close if I'm uncertain what's going on.
Andy just had a comment. It's another problem hedging with 3x ETFs is you're not getting the benefit of some of the positive theta and increased volatility as you're getting in long put calendar. So I guess that wasn't really the comment. Right.
Yeah. Yeah.
Jerry said to me about the Fed, less likely to raise as often as previously expected. So maybe that was making the market happy.
Making the market happy, but like, you know, I kind of keep saying, you know, damned if they do, damned if they don't. I mean, that means that things are bad for them not to be raising the rates. But that's just my not so humble opinion, I suppose. But anyway, let's move on. And now that I've shared an actual trade, then I'll try and explain a little bit of how what the rolling and that means. So I put the trade on, and let's just say it quickly moves. So if the market has moved below the short strike, which is the example, which is the implication of what Andy was saying, then at that point, assuming it didn't happen within a day or two, then I could buy back that short, assuming it was a calendar to start, but buy the short back and roll it down to the following period and roll it down to at the money or the next support area. Usually that would be pretty close to that without paying for the roll. So the longer dated the option is, then the more extrinsic value it will have, the more time value, volatility value, whichever way we want to look at it. So I would be buying less extrinsic value back on the short that I already have and selling one further down lower. So I'm going to go back to that example. So here, so on that, no, I did it on that day. So I guess I was anticipating on that day. Let me just see if I can. Yeah, so right here. So the short ended up at 2000 and the market closed at around 1980. So I bought the short back and I sold it lower, which was close to that support area, and I was able to collect the credit. Now, had this been deeper in the money, this original short being deeper in the money, I may not have been able to get that credit to sell out of the money, but I can typically get either credit or do it for a scratch. So the result of doing that, it becomes effectively an in-the-money put diagonal, if you like to follow those terms. So if the market's stable, then roll to the same strike, and I try to collect around $4 per roll. And the example I gave you, I collected $4.40 and $4.60, I think. And the reason I do that is because, let's just say it cost me about $3,000 to put on that trade. The example I shared was about $2,600. And that was buying 50 days on the long. That's about 7 weeks. So that works out about $4.30. So that ends up being why I try to collect about $4 so that I can be paying for that long put. Now that they're more expensive, to start off, then you might want to think about getting a little bit more than 4. Now the market can continue to move against me a little bit, so I'm not going to be not going to shut it down just because the first time or second time I try to roll I don't get the full credit that I want. I just allow the market to breathe a little bit, so I can go for potentially for 1 week and not collect $4. So I've had instances where I've just collected 70 cents or less. To keep it as a calendar in that case. So I just see a question from Boden saying, when rolling, what is your delta of your new short? So the delta of the new short doesn't bother me. I don't follow the Greeks for that, but I'm trying to sell either slightly out of the money or at the money. So it could be between a 50 and a 30 delta. When we first start off, we're probably close to 30, 35 delta for the whole, the initial position. So then I'm selling closer to at the money. Closer to at the money, that's where we have the most extrinsic value. So again, discretion based on what the market's doing, because if the market has started to go downwards, I might want to either not sell a new one or sell a slightly higher delta. So unfortunately, for those who like to have a precise rule set to trade, this isn't it. I use a lot of discretion. Okay, so let's just say I put the trade on and I didn't manage to collect the roll that I wanted. So if the market and it continues to go up, then I can just close it and then put one closer to at the money. A lot of the times, a lot of us don't want to lose on any trade, so we will keep it on and hope that the market's going to pull back. Well, there's nothing wrong as far as I'm concerned in closing that and moving it closer to at the money. So if we were, let me go back, if we, if I put this on and then the market continue to move up, I can say, well, let's give it a breather for a week. So if it had not rolled over and I collected, say, $2 here because it had continued to go up. Well, if the next week I'm still continuing, it continues to go up and I'm not making money, or, I'm so far out of the money, like this long is so far out of the money by the time we get to 120 points higher than that, that the chances of making money on that are reduced. So I would be better off closing that and then repositioning, putting on a new trade. I don't consider it as a campaign, an ongoing campaign. I just treat them separately. So, all right, so that's what I'm saying here. And then I'll just close that long within 2 weeks to expiration, or about 2 weeks to expiration. I don't let that long kind of get down to zero. And then I will, just start on a new one if it's appropriate. I see a question from Al. Just curious, what are your trades for the long part of your account? ETFs, stocks, and last year and the year before I had a lot of long calls / diagonals with calls. All right, so how are we doing here? All right, so here's a bad trade. I call it bad because I had started seeing some volatility. This is in March last year, so about a year ago now. And I started seeing lower, like this was a high, this was a lower high. We hadn't made a lower low yet. Sorry, I'm not showing what happened further back from that. I don't think we'd had a lower low yet. So when we had that little pop, I jumped the gun and put on a calendar at 2060, which cost me $2,750. And then the market moved up, so the short, got to the end of its life. So I rolled it, and look, I only collected a $2 credit. But then, the market was good to me, and we had a one-day pullback. So when I rolled the next one, I collected $6. So I looked at that and I thought, well, between the two, I collected 4 on average. But you see, at that point, just the life of the trade here, we ended up making a higher high, and we had made a higher low. So what next? Then when it got to that, I rolled it and I collected 70 cents. Now, let's just stop and think. I think what happened, that one, actually I didn't roll it, it expired. You see how that was up to that day. The market continues to go up, and then I say, oh, I can collect something. The market was rolling over, but I could collect something. But hindsight, I had already collected a small credit once. The market had changed somewhat. What if I had just closed that long and then started a new campaign, whose long expiration would have been further out in time to the one that I already had on? But, go higher. Look how that would have worked out a lot better. Instead, I chose to keep the money there and something that wasn't probably the best. But, cut a long story short, this ended up being, not an ideal entry. Had I just bought the put, I would have lost money. But I ended up losing some money on the long and making a little money on the short, so probably netted $100 on something like this. And the market was essentially flat, slightly up, I think. All right, so at the beginning I said that I'm sharing results in a just under $150,000 account. So I had no more than 2 SPX calendars on at any point in time in that. So you can tell it was a small hedge. If they were costing about $30 a piece, that was about $6,000. I think I looked, and the max at any time was about $5,500. So we all know that last year the S&P was down about 0.8, but I was able to make almost $11,000 on all of these trades, and I'll show you my spreadsheet in a second. But you see, the bulk of the money, go back. Bulk of the money was, in fact, all of the profit was made on the shorts, 18,000 on the shorts, and the longs I lost. So had I just bought these long puts, and I say had I because I may have done things differently. I'm only buying 50 days out just because I know I'm selling against them. So if it was just a case of buying long puts, the time frame could be very different. But that would have cost 4.5% of the value of the account. So, extrapolate that over time, and, losing or paying 4.5% of one's account a year for hedging is very expensive. And I've shared the spreadsheet. Tom has put them in the chat, so you can see that I had a bunch of gaps in there, so you can go analyze to your heart's content. But and everybody's commission is different. Mine's $1 in this particular account, so that's what I'm showing. I'll get to that spreadsheet of the actual trades in a minute, but what I wanted to show you here was that this is I kind of run a Sharpe ratios and Sortino ratios. Again, you can go to Investopedia and find out on what those represent. But essentially, I ended up making about 12.5% or 13% last year in this portfolio. The All Country World Index was down. I use the SPY instead of SPX because the SPY has the dividend in there, so slightly up a little bit. So not only did I have better results than my benchmarks, but I also did it with less volatility, and that is something that as traders we just need to be aware of. At least I think that's important. So yes, I do like to beat the market, but if I had had 25% But my account was down 10% 1 month, up 15, down 20, but ultimately I ended up making 25%, but I had all that volatility. Then, you end up having all these random events and random monthly results. Well, random's the wrong word, but I hope you understand where I'm trying to get to, that I'm smoothing out that equity curve, and that is the bottom line here. So I see there are some questions. So Jim is asking, did the loss on the long puts come from price rallies or time decay? I would say yes to both, because if we pull up, I think I'm done with my slides now. If we pull up the S&P, and we can see, the market last year was somewhat volatile. It was flat, okay? So if I had just gone ahead and bought puts periodically, they would have expired. If they were out of the money, they would have expired worthless. So there's your time decay. But in there were times when we had rallies in the market. So yes, you end up losing from the delta as well. And I see that there's some chatter. Are there any questions that I'm missing?
I don't think so.
Okay.
See, Jim said once your short puts expired, you wait for a down day to sell another short-term put. I don't know if you answered that one.
Again, it depends. I don't always let them expire. Sometimes sometimes I roll them. Sometimes I let them expire. I should avoid selling them if we have a down day, because at that point I should be waiting for the market to roll down, and then at that point I should be trying to make money on the long put, which is the primary objective. But since I'm a trader and I can't keep my hands off things, I do end up over trading. So you all have the spreadsheet that has 2 tabs. So this is all my actual trades for 2015. So what I tried to note was some of them we started off December 22nd, 14. So I think that was the first trade I actually shared. But I'm trying to note the SPX was down, the SPX was up. This is how each one did. Somehow with an increase in volatility, some of them can be really sweet. But then I have something that this is part of my results as well. I haven't excluded it just because I do some idiotic things from time to time, but I thought, well, the calls are working out, the puts are working out. Why don't I do it the other side? Why don't I do a call? I'll get my puts and calls correct. I have been trading puts, and then I had this bright idea that I should do calls. So I went and put it on a couple of days before we had the big crash in August. So needless to say, I struggled. And instead of going ahead and closing it, I was ending up selling some at 70 cents and 50 cents. And, but that's still part of my results. Remember, that was a bullish trade. Then I thought the market was starting to change. And then I thought, instead of doing it as a calendar, why don't I do it as a diagonal to start? So this is my longs here, and these are my shorts. So why don't I do it as a calendar? Not as a calendar, but as a diagonal. So then I'm messing around with that, and I lost some money. So I talked to myself in notes. But these are the results. So the slides kind of talk about when to sell the short puts, and again, it's a discretion. Okay, so this is 2016. So far, pretty volatile. So, the first couple of trades I put on, here's the 14th of January, the 25th of January did well. And then here's when the market has been, had the big rally. So I ended up putting 2 of them on the same day, which is not what I typically do. I stagger them, but I put one on 1860, 1870, and the market clearly broke out on the 1st of March, so I closed those, took a loss, and then started a couple of others. This was down a little bit. I don't know where the market is right now, but this was at slight scratch. So I'm up a little bit on the year. Whew. Just looking at what's happening. So volatility galore, huh? So anyway, there's that. Any other questions?
It doesn't look like it. Yeah, I think you've answered them all. Oh, I guess Ray asked, so what's the takeaway of your hedging strategy so far and going forward?
Are you asking me, Ray, what my takeaway is? My takeaway is that I keep it small. I try to let the market breathe in and out. But I also try to be pragmatic in closing things when they don't work, and know that this rule set needs to be adapted based on the changing market conditions. So while the market was strongly trending up in 2013, for instance, I expected to not make any money of this, and I ended up maybe about scratch. I don't have the exact numbers for 14. 14 was up. 13, I started in the middle of the year because I figured we had continued up so much that maybe it's time to start hedging, but that didn't go so well. 14 was okay. 15 did well, and so far we know what the volatility is doing. I'd like to go and maybe back test a little bit or at times when there's high volatility back into maybe 2011, 12, just to see what price point is reasonable, but I'm not so concerned about that. I want to remind everyone that my primary objective is to try and hedge a little bit in my my long portfolio, and also to smooth out my equity curve. I don't see any other questions, so I hope that it was a little beneficial to somebody. And if there's anything else,
Dale and a couple other people wanted me to talk about capital discussions for a minute. I guess.
Go ahead. So I'll pass you the ball back.
Yeah, thanks. Let me just share my screen real quick. And let me know when you can see it.
I can see it.
Okay, so basically capital discussions, if you're new to capital discussions, it's at the core of a free option trading community. We have forums, the libraries where all the recordings are. If you're a paid member, then you can access all these links on the different file formats, handouts, things like that. If you're not a paying member or subscribe to like one of our experts, then this link on the left of the date will always work. Normally it's going on YouTube. We have on our calendar, if you look at like a current week, we have a couple of trading groups, a Spanish trading group, a French trading group, a beginner trading group. This is John Locke's Advanced Position Management. They have a group that meets privately. Amy had a Weird or Trade review, so we have experts that have different trade alert services if you want to do that. We also have some mentoring. I have a bunch of tools like this price calculator. I use this all the time. I put in prices for 3 legs of a butterfly, and it tells me what the price is. And that helps a lot when I'm trying to get filled on different things. If, like at IB, if somebody has a 1 lot and messing up the spread price, I can come and put it in here, and then I know what the price is. I can also use OptionView too, but this is a nice, quick online tool. The forums, just so you know, is a separate login from the main site. So if you're accessing the member site and seeing what, say the FOMC meeting today, where was that? On the website, still thinking. It's a separate login. So when you go to the forums, you have to log in with a different login than the members one normally. but that's optional if you want to use it or not. A lot of them you can just read without even logging in. So those are the main things. It's a free community and forums, trading groups, tools, and if we have the extra services, the different classes that the experts that we have running different services, those are totally optional. So is the mentoring. And the mentors we have, most of our experts are doing mentoring. Brian is, Amy is thinking about it. We have another, Tim Pearson, I think, that wants to do some mentoring. I think he started with somebody already. So we have quite a few people available to mentor with different skill sets. Himanshu is he's specializing in calendars. So lots of different people to do mentoring. So that's a quick overview, just super quick. I don't want to waste a lot of time with that, but that's basically what Capital Discussions is. And with that, Evie, I really appreciate you coming on and showing us how your trading's been going. It's very interesting the way you're hedging with the puts.
Thanks for the opportunity, Tom, and everyone. Thank you for your time. I know everyone's time is valuable, and taking the time to spend it listening to me is appreciated. Thanks.
Okay, thanks, everyone. I'll get this recording in the library as soon as I can, and we'll see you next time in the trading groups and meetings next week. So I hope everybody survived the Fed. It looks like SPX is up 9 right now, so hopefully you're a little bit long. So thanks, everyone, and we will see you next time. Thanks, Evie.